The American dream of homeownership is facing its greatest threat since 2008, and it's not coming from mortgage rates or home prices. The real estate market is on the brink of a crisis as major insurance carriers abandon entire states, leaving millions of homeowners scrambling for coverage that's increasing by as much as 300% annually. Let me paint you a picture of what's happening across America right now. Imagine waking up to find a letter in your mailbox, the kind nobody wants to receive. That's exactly what happened to over 200,000 Florida homeowners who just got dropped by Citizens Insurance, the state's largest property insurer. But here's the shocking part. Citizens Insurance had about 1.2 million customers just last month. Now they're down to just over 1 million, and industry insiders are warning that another 600,000 customers could be cut before year's end. This isn't just a Florida story. From the Sunshine State to the Golden Coast of California, major insurance carriers are pulling out of entire states, leaving a wake of chaos in the housing market. The exodus of insurance companies is happening at an unprecedented scale. State Farm, a company that's been insuring California homes since the 20s, recently announced they're completely withdrawing from the state's home insurance market. They've also withdrawn from the east end of Long Island, New York, Suffolk County market as of September. Mountain Valley Indemnity is also saying goodbye to New York. Allstate and Progressive are drastically reducing their presence in Florida and California. And in Louisiana, 7 insurance companies have gone completely insolvent since 2021. But here's what makes this situation truly terrifying. It's not just about companies leaving, it's about what happens next. Take Florida Peninsula Insurance, for example. They're one of the companies taking over policies from Citizens, but there's a catch. Homeowners are reporting premium increases of 18% or more just in the transfer. And that's just the beginning. Some Florida homeowners have seen their insurance costs rise by over 300% since 2022. Let me share a story that's becoming all too common. A homeowner I'll call Brand just got his non-renewal notice. His roof is 14 years old, just 1 year shy of the typical 15-year replacement requirement. But instead of waiting for year 15, the insurance company is forcing his hand early. Another homeowner, let's call him Hutch, got dropped simply because of a handrail issue. These aren't isolated incidents. They're part of a calculated strategy by insurance companies to minimize their risk exposure. What's even more disturbing is how these issues can haunt a property long after they're resolved. Insurance companies are now maintaining databases of previous claims, even from prior owners. Imagine trying to buy a house and being denied insurance because of a claim filed by someone who owned the property a decade ago. It's happening, and it's creating a new class of essentially uninsurable homes. I would like to give you some serious food for thought. The current paradigm of mortgage lending and property insurance presents an interesting contradiction in asset ownership and maintenance responsibility. While financial institutions hold the deed as collateral until the mortgage is satisfied, and insurance companies maintain a vested interest in the property's condition, the burden of maintenance and improvements falls entirely on the mortgager, the homeowner. This arrangement contrasts sharply with other secured asset agreements, such as automotive leases, where the lessor typically assumes responsibility for major maintenance given their ownership position. The disparity becomes particularly notable when considering 1. Capital improvements. Homeowners invest substantial sums in property upgrades. These improvements directly benefit the lender's collateral position. The investment is at risk should default occur. 2. Risk distribution. Banks benefit from appreciating asset values. Insurance companies collect premiums. Homeowners bear both maintenance costs and new compliance requirements. 3. Forced insurance requirements. Recent market shifts have led to more stringent insurance prerequisites. Homeowners must fund mandatory improvements to maintain coverage. This creates an additional financial burden on top of mortgage obligations. What if we, the people, propose that since banks and insurance companies have such a big stake in our homes, they should share the cost of major repairs and required improvements with us homeowners? After all, they're the ones who truly own the property until we pay off the mortgage, and they're the ones who benefit from keeping it in good condition. This could better align the interests of all parties while creating a more sustainable framework for long-term property ownership. I'd love to know what you think about this proposition in the comments below. Let's talk numbers, and they're staggering. In Florida, if you bought a house in 2019, you were probably paying around $1,988 annually for home insurance. Fast forward to 2024, and the same coverage, if you can even get it, will cost you over $4,200. That's a 112% increase in just 5 years. California homeowners are facing an even grimmer reality, with premiums shooting up 50% in a single year in high-risk areas. But here's where it gets really interesting and concerning. When Citizens Insurance drops a policy, homeowners are often forced into what's called the dark side of insurance. Private carriers who demand extensive and expensive home upgrades. We're talking about new roofs costing $10,000 to $20,000, electrical system upgrades ranging from $2,000 to $10,000, plumbing overhauls that can cost $5,000 to $15,000, wind mitigation improvements costing thousands more. The insurance crisis is creating ripple effects throughout the entire housing market. Mortgage lenders are starting to factor in the likelihood of insurance costs dramatically increasing over the life of the loan. Think about it. If a homeowner's monthly payment suddenly jumps by $300 due to insurance increases, that directly affects their ability to pay their mortgage. Some underwriters are now demanding more detailed information about a property's insurability before approving loans. They're looking at historical claim data on the property, age and condition of major systems, proximity to natural hazards, building code compliance status, potential future upgrade requirements. Here's a particularly troubling scenario playing out in historical districts across the country. Homeowners are caught in an impossible situation between preservation requirements and insurance demands. Historical preservation boards require certain types of windows and materials that maintain the home's historical character, but insurance companies won't cover these features, or they charge exorbitant rates. The result? Homeowners are caught between government regulations requiring one thing and insurance companies demanding another. In 2023 alone, natural disasters caused $165 billion in damage across the country. But here's what's really concerning. We're seeing what insurance companies call thousand-year storms happening multiple times per year. In the past year alone, we've experienced several hundred-year floods and multiple thousand-year storms. This has led to insurance losses from climate events tripling since 2000. Risk models predicting a 200% increase in severe weather events by 2030. Reinsurance costs increasing by 200 to 400%, and companies completely withdrawing from high-risk areas. Another critical issue that's not getting enough attention is the FEMA 50% rule. If your home sustains damage equal to 50% of its appraised value, you're required to rebuild the entire structure to current codes. In flood-prone areas, this often means elevating the entire house. This requirement is forcing many homeowners to demolish rather than repair, creating unexpected costs not covered by insurance, making many older homes effectively uninsurable, and contributing to the development of a tear-down real estate market. The numbers coming out of the housing market tell a story that should send chills down every homeowner's spine. Let me paint a picture of what's happening on the ground right now. In neighborhoods across America, we're watching a dramatic shift in property values that's directly tied to this insurance crisis. Homes that are struggling with insurance issues aren't just selling for less, they're selling for dramatically less, with prices dropping 12 to 18% below their comparable insurable neighbors. But that's just the beginning. Think about this. If you own a home that's more than 30 years old in a high-risk area, you're looking at potential value declines of up to 25%. We're not talking about run-down properties here. These are well-maintained homes that simply don't meet the increasingly stringent requirements of insurance companies. The impact is even more severe for properties that need significant updates, where we're seeing price drops of 15 to 30%. It's creating a two-tiered market where new construction is commanding premiums of 25 to 35% over existing homes simply because they're more insurable. The time it takes to sell a home tells an equally disturbing story. Properties with insurance challenges are sitting on the market for an additional 45 to 60 days. And that's if they sell at all. We recently spoke with a realtor in Florida who shared a heartbreaking story about a beautiful waterfront property that's been on the market for over 200 days. The reason? No one can get insurance on it. This isn't an isolated incident. It's becoming the norm in many areas. Let's talk about who's buying homes in this new market reality. Remember when first-time home buyers made up a significant portion of the market? These days are rapidly disappearing in high-risk areas. Instead, we're seeing cash buyers swoop in, now representing 35% of purchases in these regions, up from just 22% in 2022. These aren't primarily families looking for homes to live in. They're often institutional investors who've raised billions to target these distressed properties. The urban-suburban divide is becoming more pronounced than ever. In our cities, where older housing stock dominates, we're witnessing price reductions of 15 to 20%. Meanwhile, suburban areas with new construction are seeing the opposite effect. These homes are commanding premiums of 25 to 30% simply because they're more insurable. Think about that for a moment. The insurance crisis isn't just affecting individual home values, it's literally reshaping our communities. The new construction market tells its own fascinating story. Builders have caught on to this crisis and they're adapting in ways that are transforming the market. Their warranties are now being valued at 15 to 20% of a home's value. Not because the warranties themselves have changed, but because they represent a guarantee of insurability. These new homes, built with insurance-friendly features, are commanding insurance rates 60 to 70% lower than existing homes. It's no wonder we're seeing a 45% increase in pre-sale contracts for new construction. Let me take you to Florida for a moment, where this crisis is perhaps most acute. An astounding 42% of homes in the Sunshine State are now considered hard to insure. Think about that. Nearly half of the homes in an entire state are struggling to secure basic insurance coverage. Insurance costs there have skyrocketed by 312% since 2019. We recently spoke with a homeowner in Tampa who saw their annual premium jump from $2,800 to over $8,500 in just 2 years. And they're not alone. 28% of Florida homeowners are now considering selling their homes solely because of insurance costs. California's story is equally concerning, but for different reasons. In wildfire-prone areas, we're seeing qualified buyers drop by 45%. Insurance costs have tripled in high-risk counties, and now 22% of homes require multiple insurance policies just to maintain coverage. Property values in fire-prone areas have dropped by 28%, and we're seeing an 85% increase in cash sales as traditional financing becomes harder to secure. The mortgage market is adapting to this new reality in ways that make home ownership even more challenging. Lenders are now requiring 25% larger down payments in high-risk areas. They're adjusting debt-to-income ratios down by 15% to account for potential insurance increases. Even more troubling, 38% of mortgage applications are being rejected purely due to insurance issues. The refinancing market has practically ground to a halt in affected areas, with applications down 65%. Please take 2 seconds to help me out and hit the like and subscribe if you find this video interesting so far. Each like and subscribe helps support this channel and keeps us motivated to keep making you great content. Thank you. Now, back to what I was saying. Looking ahead, the projections from industry analysts paint a sobering picture. Within the next 5 years, 15 to 20% of current homeowners may find themselves uninsurable. Property values in high-risk areas could plummet by 30 to 40% by 2026. Insurance costs in coastal regions are projected to triple again by 2025. Perhaps more alarmingly, 25% of current homeowners may be forced to sell due to insurance costs alone. The affordability crisis this is creating is staggering. Let me break down what this means for the average homeowner. When you combine increased insurance premiums, require maintenance reserves, and additional escrow requirements, many homeowners are seeing their monthly payments jump from $450 to $1,150. Annually, that translates to an additional burden of $5,400 to $13,800 just for the privilege of maintaining insurance coverage on their home. This isn't just about numbers on a spreadsheet, it's about real-life families facing impossible choices. The median income household has lost 28% of their buying power in this new market. First-time home buyers have been hit particularly hard, with their market participation dropping by 35%. 1 in 3 current homeowners is now considered cost-burdened by insurance alone, and nearly 1 in 5 is actively considering selling their home due to these increasing costs. What we're witnessing isn't just a crisis, it's a fundamental reshaping of the American dream of homeownership. The question isn't whether this will affect the housing market, it's how profound and lasting these changes will be. For those looking to buy property now, the landscape has fundamentally changed. The due diligence process must now include insurance availability checks before making offers, historical claims research on the property, future insurance cost projections, building code compliance verification, natural hazard risk assessment, and upgrade requirement evaluation. For current homeowners, being proactive is crucial. 1. Document everything. Keep records of all maintenance and upgrades. Photograph home improvements. Maintain a detailed home maintenance log. Keep all inspection reports. 2. Consider preventative measures. Update roofing before issues arise. Install storm protection features. Implement fire-resistant landscaping. Upgrade electrical and plumbing systems, and security and monitoring systems. 3. Insurance strategies. Work with multiple independent brokers. Consider higher deductibles to maintain coverage. Explore state-sponsored insurance programs. Bundle policies when possible, and document all communication with insurance companies. The role of government in this crisis cannot be ignored. We're seeing insurance lobbyists influencing legislation, building codes becoming increasingly strict, property rights being eroded by new regulations, assessment increases for public services, and lack of effective solutions from legislators. The insurance crisis of 2024 could very well trigger the next housing market meltdown. But unlike 2008, we can see this one coming. We're already witnessing the creation of a renter nation. As home ownership becomes more challenging, property values declining in high-risk areas, the emergence of insurance deserts where coverage is unavailable, a shift toward new construction as older homes become uninsurable, the development of new financial products to address insurance gaps. If you're watching this video, you're already ahead of the curve. Take action now. 1. Review your current insurance coverage and options. 2. Research trends in your local market. 3. Plan for increased costs in your investment strategy. 4. Consider property improvements that could help secure coverage. 5. Stay informed about legislative changes and market movements. 6. Get involved in local politics to advocate for solutions. 7. Share your experience to help others prepare. Most importantly, remember that this crisis isn't just about higher premiums. It's about the fundamental ability to own and transfer property. The decisions you make now could determine whether your property investment thrives or becomes another casualty of the insurance collapse. Don't forget to like this video, subscribe to our channel, and hit that notification bell to stay updated on this developing crisis. Share your insurance stories in the comments below. Are you seeing these changes in your market? Let's keep this conversation going. Stay safe, stay informed, and watch this one as well.